What happens to capital when netting assumptions break? In traditional markets, netting reduces visible risk. Offsetting positions are combined. Only the net difference settles. Capital appears protected by design. In 24/7 digital asset markets, that assumption often fails. When netting breaks down, gross exposure, not net position, defines how much capital is actually at risk. Why netting assumptions mislead? In digital assets, netting works when settlement is synchronized. Clearinghouses coordinate timing. Liquidity is centralized. Counterparties are known. Digital asset markets operate differently. Settlement is continuous. Liquidity is fragmented. Execution and final ownership transfer are not guaranteed to align. A position that appears hedged may still expose its full notional value if settlement is delayed, liquidity dries up, or a smart contract fails. Gross exposure becomes visible only when it is already stressful. Settlement risk changes the exposure equation. Settlement risk in digital assets arises during the gap between execution and final settlement. Until settlement is confirmed, capital remains exposed. Key drivers include counterparty or smart contract failure, liquidity fragmentation across venues, timing mismatches in continuous markets. Unlike end-of-day netting, exposure can change minute by minute. Capital must be available even when offsets appear intact. This is why relying on net exposure alone underestimates risk. Gross exposure is the true risk measure. Gross exposure reflects total capital at risk before offsets. It assumes every position must stand on its own until settlement completes. Institutions that manage gross exposure avoid being surprised by sudden liquidity pressure or forced adjustments when assumptions fail. Visibility into gross exposure is not optional. It is foundational to capital protection. How Kenson manages gross exposure. At Kenson, capital protection starts with discipline. We design frameworks that assume netting can fail and plan accordingly. Our approach rests on three principles: predefined exposure limits, continuous monitoring, governance, and escalation. This structure ensures capital is protected even when markets behave unexpectedly. Technology supports, governance decides. Tools enable visibility. Dashboards, reconciliation systems, and automated alerts translate exposure data into signals. But technology does not decide when to act. Governance defines how much exposure is acceptable. When escalation is required, who is authorized to respond. Capital is protected by structure, not by speed. Why discipline matters. When markets never pause, always-on markets expose capital continuously. Without netting guarantees, restraint becomes a control. Liquidity buffers, scenario testing, and off-hours escalation protocols reduce dependence on perfect execution. Institutions that accept gross exposure as reality design portfolios that survive settlement stress rather than react to it. Kenson Investments helps informed market participants design governance frameworks, exposure limits, and monitoring systems to manage settlement risk and protect capital. If your organization is navigating continuous markets, understanding gross exposure is essential. Visit kensoninvestments.com and connect with our team.